Good morning, everyone. As you can see, it's nice and sunny where I am. And Byron, I hope everyone's well. I hope everyone's been benefiting from the last couple of webinars that we've done. And I'm given sort of all the feedback I've had because I mean, I've been really busy with my own clients after doing these webinars, which has been fantastic. And the feedback or the questions that I've mostly been getting is that people sort of are forgetting strategically what we've been, or the detail of what we've been teaching them. And good opportunity for me to go through with you guys as affiliates. And I'll reflect on sort of a couple of different phases that I've gone in over in my career, and what this obviously compares to. So let's talk transition to retirement strategy, because that's the thing that's come up a lot. And then let's talk about the strategy to get there. So, and really what the guidance that I was given from my mentor 30 years ago, because everything he taught me, nothing has failed me in 30 years. And it doesn't matter what we've gone through. And whether that be conversations that I had with my accountant when I bought my very first property, and the opinions my accountant had, with all best intentions, but not coming from a space of knowledge about the property investment and sort of what I was being taught by my mentor, who, as I've mentioned to you guys, is now a billionaire. All right, so let's talk first of all from a zoomed out perspective. What is the objective here, and why do we invest? So the goal is very simple. There's three things that we want to achieve. We want to maximize capital growth, because it's in the capital growth that we create the wealth. And so regardless of interest rates, what the government's policies are when they tax reform, all of those things, we are playing get rich slow. So we're playing a strategy where it's over time. So that removes try and get in low, get out high. That removes all of that trading mentality. Now, I'm not saying trading doesn't work and that it's not possible and all the rest of it. It's just not the game that we play with our clients. With our clients, we're really focused on get rich slow. And where I got that terminology from was actually Warren Buffett. Warren Buffett was interviewed by Tony Robbins a number of years ago, when Tony Robbins actually wrote an investment book. And Tony Robbins said to Warren Buffett, geez, everything that you've taught me is very simple. Why doesn't everyone do that? And Warren Buffett's response was, well, not everyone wants to get rich slow. And his strategy was exactly what we teach our clients, where there are certain growth cycles over time, there are flat cycles, and he was referring to the stock market, and there's obviously, there's big correction cycles. In property, correction cycles are much smaller, unless we're talking about very specific markets like overvalued markets in mining towns, right, 10, 15, 20 years ago, or overvalued markets in, say, Sydney, or whatever the case may be. But when we're referring to median house price or median property price, we don't have gigantic falls out of the sky like we do with the stock market. But either way, over the course of, say, a 20 or 25 year strategy, even 15 years, there are a number of growth cycles. And it doesn't matter if we invest before the growth cycle, after the growth cycle, in the middle of the growth cycle, at the flat stage of the cycle, it doesn't really matter. We invest when we can afford to. And when can we afford to? Well, as you guys mostly would know, because most of you are brokers, you invest when the bank says that you can afford to. That's when you invest. You don't play this game. You think, I think that this is the right time to invest, because there's way too many variables. All right. So, and let me share some of those things with you. So when I was being taught all of this by my mentor, the very first property I invested in after he taught me all of this was in 1996 in St Kilda. Now, for those of you that know St Kilda in Melbourne as a suburb, it's always been known as, there's been a lot of drugs there, there's a lot of street workers. It's obviously been sort of the underbelly, right? And it definitely was in the 90s. In the 90s, I mean, my ex-girlfriend, she lived in an apartment in Blessington Street, and there was a laneway at the back. The local police told me about there was actually there was a body count that they had every year of murdered people, right, that used to be dumped there. So it was never really a really red hot suburb as far as actually a nice suburb. Definitely in the 90s. And here's me buying my first property in St Kilda. But it was a very specific property. And also I'd been taught by my mentor that it just has to gentrify. It can't be that close to the CBD and the water and be in between blue chip suburbs like Elwood, Brighton, and Middle Park without it gentrifying over time. So it has the most room for the median price to actually increase, right? And that's for houses and for units, right? For apartments as well. So I bought a 2-bed, 2-bath, single car space apartment that was halfway through completion for $255,000, right? Now, at the time, that was an enormous amount of money. It was actually more than what my family home of my parents that were still living at a 5-bedroom house in Mornington. It was worth more than that house, right, at the time. And at the time, I was full of so much fear. And I said to him, I said, look, and you're saying that this can go up in value? Because I was like, how on earth could this go up from 255,000? It just seems so high. And the yield that I got on my first tenant was actually 6.5%. And then when I actually bought that property and I had the meeting with my accountant, and I was very, very proud of myself because I bought my first property, and my accountant was the person that actually gave me the idea to start investing in properties in the first place to actually help reduce my tax. So when I spoke to him for the first time and shared that property with him, he was very excited about the numbers. And then he said, where is it? And I said, St Kilda. And then he went, oh my God, what have you done? And then gave me and proceeded to give me a lecture for 45 minutes about how I made such a bad decision in my investment. And I should have invested in Middle Park up the road, or, you know, a whole host of other areas. And I then felt pretty shit about myself. And then I realized, well, hang on a minute. Hey, Max, how many properties do you have? And he doesn't have any properties. He literally just bought his office, right? His little office that he had his practice out of, and he's paying off his home. So I said, with all due respect, mate, like I'm taking advice from a guy who's just bought his 46th property. So I'm going to follow that, all right? Because what he's taught me makes sense. Because I realized that Max was there. He was my accountant, and he was there obviously to help me with my tax. And that's literally what I made sure that he was there to instruct me on. And also when I spoke to my broker for the first time, he had his opinions as well. And I was like, look, can you get me the debt? Can you just get me the loan? I want this type of loan. Can you give me a good interest rate? And we worked out that, you know, I'd reduce some of my credit card, you know, not the credit card debt, the credit card capacities that I had, because it was too high. And as you know, that obviously reduces your borrowing capacity. So anyway, I did all of that. And then what I realized back then is to take advice from people that specialize in those areas. Now, what I was really worried about at the time, because this is 96, was the dot-com boom. And that the dot-com boom was going to crash, because that's all the papers that I was reading. And all I could see in the media was property bubble bursting, property bubble bursting, bubble bursting, bubble bursting, bubble bursting. That's all I could read in the papers in that time. And so I was so paranoid about this was a unique time that the property market was going to crash. And my mentor kept teaching me, look, stop looking at the perspective of a crash is going to happen for a very specific one-dimensional reason. You've got to look at this long term. Stop looking at this 1 year ahead or 2 years ahead. He said, look, my opinion is it's not going to affect the property market, and it didn't in hindsight. But he said, you're still focused on next year and not 20 years from now. He said, he kept reminding me what the strategy was. And the strategy was maximize capital growth, maximize cash flow, minimize risk. That was always the strategy. And how do we do that? We invest in an area with a minimum rental yield of 4%. We invest in an area that's heavily gentrifying, tick, tick. And we make sure that we're investing in a brand new property, because the property construction is catching up to the demand of the population. And so that's exactly what the focus was. And that was exactly what I invested in my first property, which I then told Max. And then a couple of years later, once I'd sort of got my 9th, 10th property, Max realized that what I was onto was actually a winner. And then he started introducing me to his other clients, and Max ended up becoming my first affiliate partner. So the point is this, the point is that we don't play a prediction game. We're going through a long-term strategy, and then we look at, well, what's the transition to retirement strategy at that point? So whilst I'm working and I'm paying tax, I continue to expand my asset base, because whilst I'm continuing to work and earn money and have income tax, and I've got an ability to obviously accumulate more debt, then I can keep expanding my asset base. So that means that I'll end up when I retire with investments, but also interest only loans and debt. And this is what, when I first meet a client to go through these strategies, this is what they struggle to get their head around, is like, well, what am I going to do with all of that debt at that time? Because most people are flat out trying to pay their own home off over the course of their working life, maybe 1.5 houses, but the whole concept of trying to pay off 4 or 5 or 6 plus properties, well, obviously the mathematics don't add up. It's just not possible. And that was never the strategy that we've taught our clients. And you're going to see in a moment sort of how this all connects to why it just doesn't completely faze me at all about what the government do, because I always work on a worst case scenario of what the government may or may not do with tax reform. So when we get to retirement age and we then decide, well, what are we going to do at retirement? How are we going to retire on these properties? So there's two main pathways that you can retire on properties. One is you can retire actually on the equity. So what that means is that you're living on redraw, right? You're actually living on redrawing on the equity on the properties. And it's absolutely a strategy, because if you think about it, if you've invested correctly and over time, the property's grown in value and the debt hasn't gone down, well, that means that you've obviously got a spread in terms of actually equity. So the loan to value ratio goes down over time. You might have started at a loan to value ratio of 105%, but by the time you retire, it could be at 30 or 40%. Depending on obviously the growth of the property. So it's very foreseeable that with the rental growth as well, you can refinance the property. Don't go silly, but you can refinance the property, increase the LVR a little bit and actually draw on those funds. Now, on the refinance amount, you certainly can't claim the tax benefit if you're drawing out those funds for, just day-to-day living or personal reasons, but it's absolutely possible. And that's obviously one way of doing it. And it's exactly what people like Elon Musk do. Elon Musk pays himself a very minimal salary. All of his asset wealth is actually in stocks, right, or shares. There's lending institutions falling over themselves to actually loan him money, and that he borrows against those stocks and then obviously draws down, right, on that debt. And that's obviously how he funds anything from that respect. And Steve Jobs did the same thing. And if you look into it, that's what a lot of obviously very, very wealthy people do. Now, do our clients follow that particular exit strategy or transition to retirement strategy? Some of them. In my experience, most of our clients don't feel comfortable going into retirement with debt and then managing debt, right, in order to do that, which is fine. You don't have to do that. But what it means is the only way that you're going to end up with wholly owned assets that you're living on the rental income from is you have to be able to consolidate. So that means that at retirement, you're consolidating, selling 1 or 2 properties to consolidate the debt on the others. Now, even when we had the 50% discount on the capital gains tax, it's still not a great strategy, because it means that you're having to give up the equity growth that you've had, the really nice equity growth on the property as it's actually performed and as you've held it all of that time. But you're having to give it up because you're still giving away a decent chunk of tax to the government. Now it's a much bigger chunk of tax to the government. So in my mind and in our mind as an organisation, what we've taught our clients is that not a great strategy. What would be a much better strategy is that you had 1, maybe 2 properties inside your super fund that if you sold at retirement, you wouldn't have that issue, right? You wouldn't have that actual capital gains issue. And so that's why in my career, most of my clients, nearly all of my clients, have at least 1 property in their super fund. And that doesn't mean they have to sell that property at retirement, but it gives them the option to. And the other thing is that it doesn't make any sense to have that property inside your super fund interest only, because there's not enough tax liability with your contributions tax to justify that. So therefore, you'll have a P&I loan, and that P&I. So that means over time, starting early in your investment strategy for your long-term strategy, you've got a property that's not only paying down the debt, but also worth whatever it's worth in retirement. So you've got a much bigger spread in equity. And if you were to sell that, you've got obviously funds that you don't have to pay tax on to extinguish debt on the others. And so that's something that we've taught all of our clients over time, and we've always had that option. And therefore, if the government start messing around with capital gains tax, and I'm talking capital gains tax outside super, because if they start messing around with it inside super, they're going to find similar sort of issues that they're finding now from entrepreneurs with the current this new current tax reform on capital gains tax with entrepreneurs if they do an exit on the business that they've built, and the government's obviously getting an enormous amount of pushback on that. Imagine if they did that inside super as well. I mean, it would be obviously a disaster if they did it, and it would mean that they would have to grandfather that ruling. So at this point in time, I can't see that happening, because as I've said to you guys before, we don't look at, well, what is the absolute worst case scenario of a government? How could they push it right to the end? It's how could they push it right to the end without actually exploding the economy and the banking system? That's really what it's come down to. And that's why I've said to all of my clients and affiliate conversations that I've had, could the government push this any further? I mean, look at the pushback that they're getting. It's enormous. So could the government have pushed this any further, especially now that we have all remembered that in 1985, the government did axe negative gearing altogether and then had to reintroduce it 2 years later, in 1987, because the rents all spiked. And look at all the rents going up now. I mean, the rents are far exceeding the spike growth than what the government actually had predicted in their modelling. It was much lower in their modelling. Everyone said that the modelling is wrong. So I'm not here to dictate what the government is going to change or what they're going to do. I just look at, well, how far can a government push it before the economy breaks or before the banking system breaks? And so therefore, that's why strategy has always been, you expand. If you can manage the cash flow and you can keep expanding, then you do. That doesn't mean you buy any type of property. It means that you buy very specific. And that's why I've always said to our clients, minimum yield of 4% in the area. The area has to be heavily gentrifying. So that means that the area is growing with young working people. They could be blue collar, white collar workers. It doesn't matter. But the population is growing with young working people. And as a result of that, there's got to be construction in that area that meet that demand. And so therefore the properties are going to be new, and that then allows us to get our tax benefits in, as well as, which creates then the cash flow. So therefore we're maximizing capital growth, we're maximizing cash flow, and we're containing the risk. We're actually in a profile of being able to manage that risk. So if we're looking long-term, transition to retirement strategy is we're either hanging on to the assets and living on the equity, or we're actually consolidating the debt from selling one or two assets and minimizing the capital gains tax by having at least one of those properties in super. And some of my clients have more than one property in super, and they've got many, many options when it comes to that stage. So instead of them being dictated by, well, this is all I can do, right? All I can do now is sell my investment property and pay capital gains tax. That wasn't really well thought through. So it just shows us that there wasn't long-term thinking. Now, let me tell you my experience in dealing with investors. And as affiliates, let me tell you why some affiliate referrals are great and some affiliate referrals are a nightmare, right? And the differences between the two. So when I sit down with someone that's out there looking for investment property and interest rates are low and the market's booming, i.e. after the GFC. So everyone was a property expert, which is enormously frustrating for someone like myself, because not many people are thinking about long-term. Not many people are planning when interest rates go up. Not many people are actually thinking about, well, what happens if there's government tax reform? They're just not thinking about that. They're caught up in money's cheap, the market's booming, greed, right? That is literally where the market is at. And it's very frustrating for me, because I'll look at what they're looking to invest in and say, look, you're not really thinking this through. What happens if interest rates go up? What are you going to do then? And what happens if there's tax reform? What are you going to do then? And so what happened then is that after the GFC, interest rates, as you know, they came down, and some of the interest rates had a 1 in front, well, mostly they were 2. Now, I could never have predicted that, right? And I'm sure that none of you could have predicted that. And even if you did you realize that it was going to go for 12 years and it was going to end in a pandemic where the government overspent that created high inflation that they then increased the interest rates from there. I didn't predict that. I don't know anyone that predicted that. But what I did tell all the people that I was speaking to during that time is I don't know when it's going to happen, but at some point interest rates are going to go up. I don't know how, I don't know when, but cyclically that's what will happen. And so that was the imprint that I left with these people. And I said, when interest rates go up, you'll realize what you've done with this particular type of property that you're choosing to invest in. And so, whilst it was very frustrating for me, I got to have a lot of conversations with people that some of them took my advice, some of them didn't. And the ones that didn't, they all called me when interest rates started going up, and a lot of them were having to actually exit out of those properties that they actually poorly invested in. And they invested based on greed when the interest rates were low and the market was booming. And so now there's a lot of fear, right? So it's either greed or fear. And as again, Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy, right? It's not hard. You just actually have to have a bit of perspective and a bit of education. In my experience, when people are really full of lots of fear, they don't actually have a lot of acquired knowledge or a lot of wisdom, which is actually the applied knowledge, the knowledge that's actually applied over time. So that was during that phase and during that period, which is obviously quite frustrating. So now we're going, and so when interest rates went up, I don't think I've actually received so many phone calls from people that I'd spoken to in the past, and they could have been existing clients that took my advice, or people that never did, or referrals or whatever, right? But I had back-to-back record years, right, of people actually taking the guidance, taking the strategy that we were teaching, and stepping out of this whole prediction mentality, because prediction is just fraught with all sorts of risk. When you start trying to predict stuff, it's too risky. And that's why I've never played that game. I definitely have never played that game with clients. When you're talking about, them taking out investment loans, or when them setting up self-managed super funds, whatever the case may be, the last thing I want to be doing is actually, talking predictions. It's just way, way, way too risky. So that's why when people have ever said to me, "Oh, can you find me something in this suburb that's of this spec and this," it's like, no, I'm not going to do that. I'm not your guy for that. You need a buyer's agent that'll take a brief from you and that is void from actually having any sort of influence about the type of investment or the investment strategy that you're trying to adopt. That's something that you want personally, and you're wanting to find something that's off market. You need a buyer's agent for that. That is not something that I'll always push those people away and say, no, I'm not your guy for that. If you want to follow a very specific strategy, you want to maximize capital growth, maximize cash flow, minimize risk, we play the get rich slow game. I'm your guy, right? And you'll follow the guidance that we give you. And so COVID was another really good example where there was all of this fear, and we held the line and said, no, we'll still follow the same formula. And then 2 years later, all of a sudden, we're heroes. And how did you predict that Southeast Queensland was going to double in that time? So, well, we didn't predict it. We just kept following the same formula. It just happened to happen very quickly in a condensed fashion because of obviously what had happened with respect to the government policies on border control with COVID. And then there was obviously a post-COVID hangover, right, in WA. And so there was always the element of people that had fear, right, as a result of that, and that's fine. But then there was people that have fear that we can educate them, and then the fear obviously subsides, and then they can actually start to now go, okay, I understand the strategy now, I'm playing long term, and if I invest now and the market's flat for 2 or 3 years, who cares? As long as I'm obviously cash flow solid, right, during that time. Who cares if the market's flat for that time? Because that means that if 2 or 3 or 4 years pass and the market's flat, then at some point it's going to go through the growth cycle, and you're in pole position when that happens. You didn't need to predict it, right? Which obviously is the most important thing. Now, to come back to something that I mentioned to you guys at the beginning of this, is that a nightmare affiliate referral for me is someone that's out there kicking tires, looking at the market, wants to invest in a specific area, all the rest of it. You can now see why someone like that is a very frustrating person for me, and a lot of affiliates have this perspective that they're the people that we should be referring, right? And sometimes it works, but it's really hit and miss. And let's face it, the reality is that if you refer someone to us, we want it to be win-win. You want to be getting more investment debt from that client. You want them to be looked after, and you want them to be obviously going through a really solid strategy where they're creating wealth. They're getting really strong cash flow, and they're getting really strong capital growth, right? So someone that's actually tie kicking and speaking to lots of people and all the rest of it, they form their own opinions, and I guarantee you they're playing a prediction game. I guarantee you they're trying to work out how to predict markets, because that's been my experience in 30 years of dealing with affiliate referrals. The affiliate referrals that are really successful for you and us are the ones where they haven't really thought about that they could even afford it. Because in my experience, most people, the concept that they have is that I can't really, I'm finding it hard to pay off my own house quick enough. I can't imagine having a second mortgage on a second property. I can't afford to be doing that. And it's not until we educate them that they realize that can actually be creating not only cash flow for itself to wash its own face, but it can actually create cash flow to help them with their own mortgage as well. But they needed to be educated from that. And it's in that education process that from your referral, then they start creating a loyalty to you, and then obviously a loyalty to us. And then that's when we have not only one property that they actually add to their portfolio, but the second and third and fourth and fifth over time. That is a fantastic referral base. And they're the ones that I've always encouraged my affiliates. It's not the ones that come to you and say, oh, I want to buy an investment property, but I'm not sure where. I'm thinking about buying in these areas. I'm not saying don't refer them over to us. I'm just saying that on the long term, they're not the highest value clients for either of us. The highest value clients are the ones that don't even know that they don't know until you encourage them to actually just have a chat. And then we've got, as you know, we've got a 6-step process that by the time they get to step 6, they're educated, they've taken action, and they're already thinking about what they could do next. That is obviously a very, very solid client for us. And that's why out of all of the 2,500-ish clients that we've got, I think it's nearly 2,700 now, of the clients that we've got, we didn't get flooded with phone calls of them worrying about this government reform, right, when they're tax reform, because they're well educated, right? We've spoken to them a lot. They're well educated. They're not freaking out. And in fact, because I've been pretty solid in my own appointments since, and I know some of my team have been as well. And it's all based on the fact there must be opportunities now that this has happened. And of course, there's opportunities, and that's obviously how it works. So I just wanted to remind everyone today, let's just be reminded what the transition to retirement strategy that we teach our clients is, and that the tax reform that happened, if that's the best that you can do, government, if that's the worst that you can do, which I reckon it is, then our clients are better off as a result of it, right? They were certainly not affected by it, right? And that's why it really hasn't touched the sides for us. And also from the perspective of us educating the client to then them be investing in properties. It doesn't matter where it is. It doesn't matter what state it is. There's obviously an overall strategy, but then there's got to be an individualized strategy based on where their current assets are, so that we're not increasing their land tax in one state just by investing in the same area all the time. That doesn't make any sense. We obviously want to spread it out across multiple states. And that's why when I've met clients that are high net worth and they've got a borrowing capacity of 5 mil or 6 mil or 7 mil, and they're looking at multi-million-dollar properties, I'm not saying to them, don't do it. I'm saying if you're going to do that, well, then at least have diversity with smaller price-based properties in multiple states to start mitigating risk and start diversifying land tax as well as growth as well as cash flow. All right, so let's leave it at that. We'll announce. I think what we might do is we probably might do these fortnightly for a little while. And as time progresses, you guys will now start to see why this is really a time for us to shine, is when these sorts of things happen. When interest rates go up, or now with tax reform from the government, as to why the guidance that we've given our clients has always been so solid. We don't even have to pivot. We just keep doing what we've been doing. And as a result, there's all sorts of opportunities open up as a result of it. And that's, again, what I've done for my whole career. All right, guys, enjoy your day. Look forward to speaking to all of you at some point, and look forward to speaking to some more of your clients. All right, take care.